As mentioned earlier, the difference between bonds and loans is that bonds can be publicly traded. An instrument that is traded publicly therefore needs to be priced in order for it to be bought or sold. Pricing a bond is done by taking the present value of future cash flows. In order to get the present value, that is the value of cash flows today, we need to discount the cash flows by a discount rate. By discounting, we mean dividing cash flows by the required rate of return. This interest rate is the return one could obtain if they invested in a similar asset, and by a similar asset, we mean an instrument with the same risk profile. Let's take an example of a bond instrument. This is a 5-year government bond with a 10% coupon. In column E, you have the tenor 1, 2, 3, 4, 5 years, the coupon interest in column F, the principal repayment in column G, the $100 the buyer gets back at the end of the tenor. This is called redemption. The total cash flows in column H. In column I, you have the discounted cash flows. So each cash flow is discounted for that tenor based on the discount rate of 11.35%. When you add all the cash flows, you get the price of the bond, which is 95.05. The discount rate is the required rate of return. Now, if there existed an alternative instrument, which let's assume yielded 12% with the same risk profile, people would prefer to invest in the 12% instrument since it provides a higher yield than our 11.35% GSEC government security. This would cause the demand for our 11.35 yielding bond to fall until the yield of the bond moves higher to 12%. We see that in order for the yield to become 12%, the prices need to fall to 92.79. We can see here that as discount rates increase, bond prices fall. So if the discount rate moves up to 13%, the bond prices fall further to 89.44% of the face value. So if the face value is $100, then the price is $89.44. If the discount rate falls down to 10%, which is the same as the coupon rate, the bond price now equals the face value. If the discount rate moves to 14%, then the bond prices fall to 86. If the discount rate falls below the 10% coupon rate to 6%, the bond prices move higher. So therefore, you see this very important inverse relationship between bond prices and the discount rate. This is the crux of the whole exercise. There is an inverse relationship between the discount rate and the bond prices. If market interest rates, also known as the expected required rate of return, aka discount rates, moves higher, the bond prices drop, and hence it's bad for the bond markets. If the interest rates move lower, the bond prices move higher, and hence a bond market rally.